Hi, it's Jeffrey Cohen, U.S. Advanced Computing Infrastructures, Inc., Chicago Quantum. I am Jeffrey Cohen, president and founder, and I'm here to talk to you about our business. I'm here to talk to you about what we found. We actually found some insights that I thought were actually pretty darn important. And so I'm going to share them with you. We're going to talk a lot about it. And I call this episode The Tale of Two Markets. And I want to explain what I mean by that. So, we ran a bunch of different models over the weekend. The first model we ran had the expected return of the stock market at 10.57. It's 10.57. Jeff, what does that mean? So let's see if I can show you in a note. Expected return of 10.57% is made up of capital appreciation, so how much your stocks go up, of 9%. And that's just an estimate. And then you have dividend yield of 1.57%, which is more actual for the past 12 months, based on average price of all the stocks and the dividends they paid. And so if you look at that, you think, oh, okay, that doesn't seem like a lot. I put my money in the stock market, I'm going to earn 10.5%. And that's coupled with a risk-free return of 4.9%. Okay, and this is actual. You can earn it today. In fact, you can earn 5.1, but just whatever. It's a conservative risk-free rate. And so what that means is your expected market return to risk is 5.67%. So call it 5.7%. So if you put your money in the stock market, you're expecting to earn an extra 5.7% than you would have earned by just leaving it in a treasury, right? A U.S. Treasury bill. And that's fine, right? So this is a number you can kind of sink your teeth into. All right, Jeff, so what are you telling me? You're telling me if I believe that the market, the S&P 500, the NASDAQ, the Russell, all of them, the Wilshire 5000, are going to go up 9%. So if I put in $1,000, I'm going to have $1,090. Okay. And what do I get for that? So what the model said you got for this high risk, crazy assumption, which isn't that crazy, is you got 5 stocks in a portfolio. And those 5 stocks, this is how they're doing today. W, MSTR, Cenex, Apps, and AFRM. High flyers, sure. Popular, e-commerce, new economy stuff. And you see that if you had put $1 into all 5 of them, you'd actually about break even. You'd actually be down a little bit. So the market isn't trading like it's going up 10.57%. Now this is the optimum portfolio from a risk-adjusted basis that took hours to find, and it's not doing that well. So what that tells me is the market isn't really trading like it's going to go higher. In fact, the market's pretty flat. It's not crashing lower. The Russell's up 0.75%. The NASDAQ's down 0.1%. The S&P 500 is down 0.125%. And in fact, your 5 stocks look like they're down 0.25 point. And so the market is trading very flat. Very risk off, in fact. So this is your risk on scenario. And we're going to create a risk-off scenario. In fact, I've already created it. We're going to show it to you. And we're going to talk about what changed. So in the risk-off scenario, the expected return of the stock market isn't 10.57, it's 8.57. The capital appreciation is 9%, it's 7%. That's against a risk-free rate of return of 4.90. That doesn't change. The treasuries don't change. And so your expected market return is exactly 2% lower. It's 3.67%. And so on 3.67%, again, risk on. Risk on was amazing. It said buy 5 stocks. The risk off model said buy 85 stocks. So very different result. And when you look at the market, you think, all right, I buy 85 stocks. I mean, I can look, what kind of stocks are they? But it almost doesn't matter. What matters is you are in a highly diversified, you've got AT&T, Apple, AppV, you got Meta, you've got Ford, you get General Dynamics, Pepsi, Pfizer, P&M Resources. You got the QQQ, so one of your holdings should be the QQQ. You got Starbucks, you got B. Riley, you've got everything in here. Walmart, T. Rowe Price, TJ Maxx. So it's highly diversified. Cisco. And so what I realize is, and this is thanks to somebody that I care about who actually took an interest in our run, reviewed it, gave feedback, and said, Jeff, you gotta scroll all the way down that rabbit hole. You gotta figure out what does it mean. You can't just say expected return. I guess you can ask a client what their expectation is. But in this case, we could close loop it. And we did this last week and it worked. We could look at the expected returns at the model is the tipping point for the model. In this case, capital appreciation of 7% says risk off by 85 stocks. Capital appreciation of 9% says risk on by 5 stocks. Now, it seems pretty amazing that Wall Street, that the world's investors are thinking in terms of a 2% difference driving behavior, but it appears they are. And so what I'm going to do pretty much every day is I'm going to look at the longs for the day, right, when it's risk on. And I'm going to look at the risk off as well. And I'm going to start to keep track of, is today a risk on day or a risk off day? And within 7 minutes of the market opening today, I knew the market was risk off. Now, what's funny is I have my own personal investments and they're also trading like it's a risk off day today. They are not happy. They're not happy, right? And so I look at FinViz. How's FinViz doing? And by the way, I'll check for questions, see if anyone has a question. If you do have a question, go ahead, put it in the chat. Ask me anything. I like it when you ask a question. It helps me to understand what you're thinking. And there's lots of other details in this run, but the basics for me is, how do I know what the market expectation of return is? Now, here's the other interesting thing. So I wrote a Medium article this morning because I thought that you would like to know what happens, under what investing scenario does gold shine. Now, I haven't had gold in my portfolio in a really long time. In fact, I used to always have 3% of my investable net worth in gold. Did. I mean, I have a gold watch in a safe, but that safety deposit box, but that's not what I'm talking about, right? Like I used to have money in gold. Gold stocks, gold miners, gold ETFs. I loved it, right? And I haven't done that probably 25 years. So why? What's going on? So we were running our model and we made a mistake. It was like discovering penicillin, right? We set the risk-free rate of return to 9%. It was 4.9, and instead of going 0.049, I did 0.09. And by the way, the capital appreciation rate was also 9. So it was 9% risk-free, 9% capital appreciation, plus 1.57% dividend. And all of a sudden, what do I find? The model loves gold and gold stocks. The model also wanted a bearish bet on the US dollar. That is a very different outcome. And so I just want you to think about it, because when I think about interest rates going up, I think that the gold stocks are the worst because gold does not pay a dividend or an interest rate. And then I think if interest rates go up, why am I bearish on the dollar? I should be bullish on the dollar. Completely the opposite. You look at the math. The only thing I could imagine is if the rate of return for putting your money in treasuries is the same as the rate of return of putting $1 in the S&P 500, then people who want risk are going to go somewhere else to find it. The dollar becomes, in a sense, worthless. I got to get out. So bearish bets on the dollar, and I want to be in gold because the dollar is becoming unhinged. If interest rates tomorrow morning were 9%, you'd become unhinged. I'd become unhinged. First off, I'd change everything. I'd sell every stock I had, and I'd lock up my money for a 9%. If I can get 15%, in a 30-year U.S. Treasury, that wasn't callable. You don't think for a minute I wouldn't sell everything? I'd sell this microphone. I would. I'd probably get $20 for it, and that's it. I'd put it into 15% Treasuries, and I'd stop because I'm earning more risk-free than I am from risk, and so that's where gold shines. And so I had somebody, I want to say they were called Godzilla. Godzilla, everyone's got cool names out there. Godzilla Trading. He said, I'm short the dollar. I hate the dollar. I'm not sure. I'm short gold. I hate gold. Gold's weak. I'm out. Gold, short. And I said, don't be so hasty. As interest rates rise quickly, gold might be the best place to be. But this guy had like a 1 hour time frame. So that's fine. So that's the other thing we saw is gold shines and the US dollar dims if US interest rates skyrocket to the point where they equal the capital appreciation that you and I expect from stocks. It shouldn't be that way. There should be more return from risk. And this is why it's so important to go back and test. What is the expected return of the market? Am I buying 5 stocks and making a boatload of money like last week? You saw the video last week. AFRM was the number 1 stock. The model said pick 1 stock. I mean, maybe 5, maybe 1. And that stock was up 5% in 15 minutes. Today, those stocks are flat to lower. And if you have a capital appreciation expectation of 7% and you're in 85 stocks, it's kind of like buying the whole market. So you're kind of breaking even. You're not feeling that bad. You're about breaking even, right? You're not feeling bad. So this is the difference. The difference for you is where's everyone's head at, and how do I know that, and does that change my answer? So as long as I believe that you believe that the market's only going up 7% or less, 6%, I know that I do not want to be making these bullish bets. I want to be conservative. I want to make smarter investments by not being in the riskiest stocks. But if at some point things pop and I realize, hey, there's some good economic news or something happened, And now people have reset their expectations. Or maybe the S&P 500 falls by 10%. And now I got all this room to go back up, right? There's a lot of chop in the S&P 500. If the S&P 500 falls for a week, the next week it probably could go up a little more. And so there's your expectations being set. And so that's where my head's at. When I look at the S&P 500 right now, and I go back a year, all I see is beach chop. Beach chop. It's crap. I see garbage, basically. I see up and down. That's not a way to make money, right? Let's draw a line. Let's draw a regression line. I actually don't know what this is going to show. I don't even know how long this model's for, but let's do it. I show a regression. It is almost exactly flat. It is slightly lower. Let's make it nice and fat. There. Slightly lower, very fat, right? And I'm like, all right, that's cool, right? So if the market goes down, I expect it to go up. If the market goes up, I expect it to go down. There's no trend. So, in fact, I don't see a 7% return. I definitely don't see a 9% return. I see chop. Feels like if I'm betting on the roulette wheel. Sometimes you're up, sometimes you're down. There's no pattern. If I look at the MACD, the accumulation and distribution line, I see we're about the same. We have not had a real drive higher or lower. I look at the RSI, Relative Strength Index. You know, we've been between 20 and 80. Now we're a little higher. We're at 62, right? We're a little positive right now. But that doesn't mean we're not going to fall down to 35 like we were in March. And your stochastics are really rotating right around a mean. It's interesting because the short-term stochastics are falling below the long-term stochastics, which shows we're entering a period of weakness, which could show you why expected return of 7 versus 9. So this is where my head's at. My head says, I want the market to go up. I'm a very optimistic American. I'm very much a patriot. I'd like the market to go up. But I look at the market and I see no evidence it's going to go up. And I don't see any activity like it's going to go up. And so I think you still got to be conservative. We are risk off because risk on isn't going up. And that's my lesson for today. We're a tale of two markets. And they're very similar. The difference between 7 and 9% shouldn't blow your head off. All right. I want to thanks for watching. I'm excited that you're watching. I think it's great. Go ahead, ask me anything. We can take a quick look. You know what I'm going to do? I'm going to leave the recording on. I'm going to take a quick look at what I look at. And you can just follow along, right? Let's see. Can you actually even see me? I was thinking maybe not. This whole... Yeah, you can see me. That's cool. So let's take a look. What are we doing, Jeff? What are we looking at? Well, the first thing I like to look at is where am I on Twitter? And I asked what's happening with Satsuma, which is a drug company. Haven't heard from it in a really long time. So let's look. Satsuma failed a drug trial for the second time. And Satsuma's at $1.16, $1.17, and yeah, it's up 78%. I have no idea why it's up. It's a nasal spray. Seems risky. Seems very risky. Okay, that's interesting. I look at yellow. I'm a big fan of Yellow Corp. You've heard me talk about it. I have a small, long position. I'm bullish on yellow. I think they're very important to our country, and they have a chance to earn their way out. I think it's great. ATI Physical Therapy. I'm long ATI Physical Therapy. You can see some weakness here over today, but over the month, you can see it bottomed. It looks like it's recovering a bit. Too early to say. I'm actually running a model on ATI Physical Therapy. that I think will enter me into the loony bin, the funny farm. ATI Physical Therapy. Enter the funny farm. So what's it going to take for ATI Physical Therapy, bottom up, to make $200 million in revenue per quarter, or $800 million a year, with their existing 923 stores or clinics, and be immensely profitable, and be back in a position to start buying more clinics, opening clinics, acquiring other companies, and building this franchise? They've had a couple of bad years, and so what's it going to take? So when we look at this, you need a revenue per store of $216,685 per store per quarter. Okay. There's 63 days in a quarter. How do I know that? I'm not really sure I know that. I'm going to put a hat on for you folks. Let's do it. How do I know that? Because 2 stores right in my area are closed Saturday and Sunday. So I'm assuming 21 days a month on average. So revenue per day, they've got to produce $3,439 in revenue. Now their average revenue per visit is $103.70. I figure round it up to $104. They got to make $104 either through insurance premiums or what people pay. Now what's interesting is I was talking to my neighbor who doesn't use a licensed physical therapist. They use Bob. Bob's a great guy. Bob, oh my God, Bob is so awesome, right? He has them stretching. They're older. They're like in their 70s. And so Bob charges $100 an hour. So revenue per visit of $104 doesn't seem unreasonable for operating under the care of a medical physician. Now visits per day, this is where it gets tricky. You got to have 33 visits a day. Today they have 24. So if you could somehow get 33 appointments, you're doing fine. Now I modeled out that there's an average of 3 physical therapists per store, and you're paying them. So, you can do 11 physical therapy visits. Sometimes you're going to have to double them up. It's fine. I remember I had knee surgery. They constantly had me doubled or tripled up, right? Are you saying over there, Mr. Cohen? Mrs. Smith, you're over here. Hey, Bob, you're over there. It's probably the same Bob that's doing the physical therapy for these new people. And we all work together. And I didn't care. My knee felt so much better. I felt great. I didn't complain, right? Visits per physical therapist per day is 11. The cost per physical therapist for visit right now is $54. But if you can get more people in, you can lower your cost per physical therapist for visit, which allows you, after having all the costs per store and per brand and per marketing and per billing and headquarters and SG&A, you're going to run a nice tidy profit. Now, it's hard to get from 24 visits per day per clinic to 33, but that's all you have to do. And you know what's going to drive that is referrals. Now, when I got my physical therapy done, I had it done through my hospital. So my hospital suggested I go to my hospital's outpatient clinic, where they still had 1 physical therapist for every 3 patients. They probably charged $200 to my insurance, and who knows what they made. I'm saying you can get referrals from doctors' offices. You can get referrals from athletic associations, schools, etc. Sports teams, right? Sponsoring sports teams, McDonald's, and other brands. You could do things like the marathon, whatever. But you want referrals. You want doctor referrals. You need them to get from 24 to 33. Or you need great marketing. I don't know. Kind of like, it's tough though, because most people don't choose to go to physical therapy. Most people had a car accident, or a work injury, or a torn rotator cuff, or their elbow hurts, or they fell, or they had an accident, right? They're not shopping for physical therapy. They're doing it because they have to. The doctor says who to go to. They got the insurance. Maybe they got an HMO. We have an HMO. Has a card. You go ask your doctor, what do I do? The doctor says, go here. You go there. That's it. But if you can get from 24 to 33, this whole game changes. Now, the other thing you could do is you could take your number of stores up. But I'm not sure I would do that right now. And the reason I say that is you got to fix your current operation before you start building more stores. And if you can get your revenue per visit up, I mean, that would be great, but I wouldn't hold my breath on that one. That one feels very much like a bit of a fantasy. I'll take it. Not optimistic. I mean, the other thing you could do is have more physical therapists per store, but these aren't very large stores in some cases, so I don't know how you do that. And so what you're really trying to do is drive this number, right? If you can drive visits per physical therapist per day, right? And now, I'm going to guess now it's 8 to 11. You need it to be 11. Today it's 8. And this is the problem, right? You got to drive that number to 8 to 11. This is the other thing you need to do. You need to drive, not that you're hiring more physical therapists to handle the 33, but you're getting them in. So I believe it's possible. New leadership team. I'm in. Now I look at the stock. I might be the only one in, to be honest with you. It's a tough stock to bet on, right? I mean, the thing was 40 cents. 40 cents, it dropped all the way to like 23 cents, 24 cents, up to 30, who knows. But at least you can, at least it has revenue and it has operations, and you can kind of twist your mind around. I got to get people into a physical therapy clinic, and these are licensed physical therapists, and there's a moat around that business, and yeah, I buy that. By the way, there's another company that does something similar. I want to say it's U.S. Physical Therapy. Here it is, USPH. And U.S. Physical Therapy has fewer clinics, but is profitable. Earnings per share of $2.26. Right? 13 million shares. They made $26 million. Call it $27 million. Okay, the company's worth $1.4 billion. They make $24 million. They're worth $1.4 billion. So 24 times 4 is 100. Times another 14 is 40. It's 56 times earnings. Can you just imagine if ATI Physical Therapy, even with the debt, I think they have $600 million in debt. Even with that, that puts their cap at $800 million. Call it 80 now. 80 to 800. 60 to 600. It's a lot of zeros on the end of your bank account if you bought the stock today. So I believe ATI Physical Therapy has a strong case. Now, Atlas Lithium, I'm the opposite. Atlas Lithium, I want to short this thing so bad that I can taste it. Now, I don't like shorting stocks. It's not my thing. And Atlas Lithium has a reason why it's gone up. It went up because it moved from over-the-counter, like the pink sheets, to being NASDAQ Capital Markets listed, and that's worth about 2.5 times. They also raised a lot of money. They sold a lot of stock, but they sold it restricted. They sold it to people who promised not to sell it. So I want you to think about that. They raised money. They bought new mining rights in Brazil. And they raised the money from people who promised not to sell the stock. I mean, that's great. That's like having your cake and eating it too. But at some point, those investors are going to want a taste of the good life. Now, maybe they don't need the money. Maybe they only sold it to very rich people that don't need the money. But my guess is if you bought the stock for $7 and it's trading for 23, you're going to want a little taste of that. Especially if you're not a U.S. citizen and maybe the tax laws are a little different than ours. You want some of that. I think this is amazing. I want to short this so bad. I am not short it at all, but I want to because it's crap. It sells industrial sand, like $6,000 a year's worth. $6,000 of industrial sand and a whole bunch of mineral rights for lithium. And it trades for $144 million market cap. On a dream of maybe finding lithium. And then maybe ramping up to extract lithium at volume and adhering to all the regulatory requirements in Brazil, which are not simple. Yeah, I'd take that short any day. Last time I called my broker, he said, no, thank you. So maybe once a week I'll call and I'll be like, look, I'd like to short 100 shares. Give me 100 shares. I got to have a taste of this because it's not worth $23.17. It's fine. So let's take a look at YouTube. What's going on with YouTube? Mara. Well, that's interesting. I actually follow Mara. Oh, there's Godzilla. Shit goes are moving. Good complacency index. I don't know. It's a submarine. Dollar's creeping up. Sharp reversal. Oh yeah. Maybe. Maybe not. I'm not really reading anything. So you could see Twitter most of the time when I look at it, it feels like a big fat waste of time. That's just what it is. So good news is my yellow investment's up about 8%. So at least I'm not going to have to sleep on the street tonight. The S&P 500. How'd we do? We're flat. What a surprise. We're going to be flat a long time. Look at that regression line. We're above the regression line. Probably coming down. The smart money thinks we're probably coming down. So the smart money is avoiding the risk on. See, two of them are down now. We're down. Risk on is down. This is what it is, right? Live with it. Stocks that I'm following, or my holdings, whether long or short, dude, okay, not great. Not great. Not too happy. ATI Physical Therapy's down a penny. Yellow's up 3 pennies. Atlas Lithium is up $1.72. Right? This is crazy talk. All right, how we doing on the markets? You see that? We're just rotating around a very narrow axis. Not much movement. Not much movement. Not much movement I understand. Maybe that's the answer. I mean, there's weird names like State Street's down 12%. That just hurts to see that. Schwab's up 2%, but I heard it was on weak earnings. So that's fine. See, State Street, interesting. It's just tasting new lows. It's returning to where it was. Schwab down, that makes me concerned. You know, Schwab is our custodial agent. So if you invest with us, we have Schwab hold the money. Schwab is our grand arbiter, right? They hold the money. You work through Schwab. We work through Schwab. And it keeps everyone clean. I like that, actually. But I don't like to see their stock down to $50. I liked it at $80. I felt like I was dealing with a rich business, not a not so rich business. Then you got SMLP. Now it's interesting because I think this bond is a very nice bond, very risky, very nice. It's a preferred hybrid. I like it. I like it. I don't own it, but I like it. Maybe someday. Maybe if I do some different things, I can do it. I don't know. I feel like Twitter today is managed. So this is one of the web pages I use. I use the Chicago Board of Options Exchange equity book. And so here you see on the BZX, I had that written down, which one that was. And you get the BYX, and you got the Edge X, and you got the Edge A. Now, Edge A traded 862 shares, which is not a lot of shares today. And so you can look at it, but really, there's not really much to look at, right? 862 shares. If I look at BZX, it's 1,278. Not really much happening. A couple of hundred shares. 40 shares. This one, 5,400, and you can see 2,700 looks like it was bought at 28 cents a share. So it looks like somebody was trying to buy up a few shares. That's cool. I like the stock. And so you can see there's an order in right now for 3,700 shares at 2,700 and 4,500 shares at 2,809. I also learned Friday that this does not include your New York Stock Exchange orders. So unfortunately, for like an ATI physical therapy, this is an incomplete list. Don't think you're going to use that to take advantage. It just doesn't work. But it's interesting at least to see where's the top of the book. I don't even know that this is the top of the book. But it looks like I'm at 2739 to 2819. 2751 to 2807. 5107. Here's 51. So we're at 2751 is the bid. I get that. The ask at 2807, I'll buy it. I'll buy it. So 2751, 2807. So if someone's looking to dump a bunch of shares, they're going to sell it at 2750. If they're looking to buy, they're going to probably buy at 28, 2810, 2820. If we take a look at what the last order was, this is real time. This is free. NASDAQ has real time quotes for individual stocks one at a time. And you can see 2780, 2780, 2779. So someone's right in the middle. They don't really need to buy. They don't really need to sell. They're just kind of right in the middle. But you can see here, unlike on the other page, 14,000 shares were traded at 2750. So it's interesting. And another 1,000 shares at 2750. So it looks like there's somebody out there wanting to buy at 2750, 2751. Maybe they were buying earlier today at 2730, at 28. And so, yeah, there's like a floor at 2750. That's fine. It's not bad. But you kind of know that now, right? You're looking at it, you're thinking 2750. You see a couple hundred shares here, but you realize it's probably not just a couple hundred shares. It probably got spread across the book a little. And there's probably a couple thousand shares, maybe 100,000 shares, 50,000 shares at 2750. Now we can also go to, and I didn't open up Book Viewer today because I wasn't planning on trading today. I was planning on just kind of watching, doing a little navel gazing. I woke up very early. I was at the trading desk here at about 4:30 this morning. I couldn't sleep. I had a dream that said I'm not making enough money. I'm not successful enough. I need to work harder. I need to focus more. I'm failing in my mission. And I was going to be left to die with a bullet wound in my leg. Because although I helped a client avoid true harm let's assume it was a metaphor, true harm to their portfolio, to their bank account, I took a collateral damage hit and I was being left for dead. Because when I said to them I wasn't making a lot of money, they said, fine, and you should die. So it's not a nice dream. I woke up, I got right to work. It's very motivating to think that you're going to die because you're not profitable. So I look at ATI Physical Therapy. I don't see any major buys here on the book. If I do it by price and I go 120, I see nothing. I see 12,800 bid and I got 13,100 ask. I got nothing on the book. How does that compare here? If I just look at the top 5, it looks like 1,000. That looks like maybe 1,000. That looks like 5,000 on each side. Yeah, maybe I'm close. So I look and it's a very thin book, right? So if somebody wants to come in here and build a position, one of these market makers, the MPIDs, are going to have to basically put the position on their books. That's cool. That's what we pay them for. Whether it's FLTU, I should probably make this bigger for you people to see what I'm talking about. You have FLTU. Now GSCO is Goldman Sachs. Then you got VIRT. I used to have all these memorized. SGAS, ETMM, IMCC. So they're all willing to make a trade. They all need their computers to be told if the stock goes like to 25 cents or 26 cents or 27 cents. They want to know because their computer's going to make them do things. Same on the other side. 28 cents, FLTU. 29 cents, Goldman Sachs. FLTU again at 29. Goldman again at 29. Goldman again at 29. VIRT at 30. SGAS at 30. ETMM at 30. IMCC at 31. They want to know. Their computers want to know. If the market moves and the stock were to scream higher, it's going to react. And that's just, you got to know. This is how it works, right? So I got a couple different sources here for demand. I got the NASDAQ Book Viewer book. I've got the Chicago Board of Options Exchange book for 4 different exchanges. It's interesting. I see 4,000 shares offered at 2809. See if I see it here. I don't see it here. I don't see it here. So that must be listed right on the New York Stock Exchange, but it doesn't make sense because it's EdgeX, and that's not New York Stock Exchange. So I got 2984 ask, I got 2807, I got 31, and I got 2819. I don't know. I'm not seeing the same thing. So now I'm nervous, right? Because now I'm gonna look at NASDAQ. Real time quote. I see 2746 and I see 2808.4. There's my 4 shares. 100 shares. Okay. So I'm not going to buy very much at 28 cents. I'm probably going to have to hit 28.50, 29 cents. All right. So it's a thin market. It's illiquid. It's interesting, right? All right. I got it. There's no news. There's nothing going on. I'm not going to expect to get rich quick on this thing. I could also take a little look-see at the actual chart. See if something pops for me. And I think I know the answer. Nothing's going to pop for me. I'm just going to look at it. I'm going to see there's almost no volume traded. Almost none. My MACD is 0. My RSI is right around 50. And my stochastics look better in the short term than they do in the long term. So this little pop right here is good. It's good. It's a good stochastic short-term momentum burst. But I don't see it continuing. And in fact, I bet if I were to run this, not for the day, but let's say on the 15-minute, the stochastic indicator fell negative. It fell below the red. It is negative momentum. I'm losing energy. I'm losing focus on the stock. No one seems to care. A couple of shares getting bought. There's no action. This thing has no... The MACD, it was up. We were up. We were looking good. And now we're looking like crap. It looks like there's actually a distribution going on. Maybe people loaded up the truck on some shares, not a lot, but some, thinking that people were going to buy more, and now they're not buying more. It's Monday. They're bored and they're tired, and they think the market's only going to go up 7% this year, and so they're not buying. And that's fine. That's just what it is. That's the facts. It's not what you want it to be. It's what it is. It's good to know that. Now I look at the rest of the market. I see it is falling lower. S&P 500 is down 0.15. Now this is not even close to real-time data. Let's take a look here. This is the S&P 500. It's down 0.16. Let's take a look at the SPY, which is the S&P 500 ETF. It's a stock. It trades, right? It's down 0.18. I'm more likely to get a closer to real-time number there. So I'll shut down State Street and Schwab. I already got what I needed there. And they're down. AMD's down. Google's down. Netflix is down. Some of the new era stocks are down. Okay. My Summit Midstream preferred stock hasn't traded since the 3rd. You know, I called my broker to buy this. He's like, what are you, crazy? What are you, knucklehead? Asshole? I think he called me an asshole, which on a recorded line, I don't think they're supposed to. But he explained to me how to read this. He said, Jeffrey, I'm not going to teach you how to read this. So I had to ask a lot of questions. He said, a client sold it to a trading desk. It was reported by the trading desk. Client, you and me, sold $565,000 of par value, $1,000 a share, preferred. So 565 shares of preferred stock. And they sold it at a price of $61.88.9 or $618.89 a bond. And that was that. And M, I think that means, yeah, commission is included. No, a markup or markdown is included in the price. So the price includes any markup, markdown. There you go. And in the next trade, a trading desk sold it to a trading desk. It was reported by the sell side. So what I'm thinking is, somebody bought it and then maybe immediately flipped it to another trader, even in the same bank, that wants to hang on to these. And that's on the 3rd. It's settled on the 5th. So at around the 8th, I talked to my broker and I said, can you get me some of these bonds? Let's say I want to buy 50 of them or 50,000. I want 80 of them. And he said, Jeff, there's no valid, at the market kind of quote available. So call me every day and I'll see if I can get you 80,000. It's fine. It's interesting though. It's interesting. And that's using FINRA. FINRA-markets.morningstar.com. I love it. I love FINRA. I love it. So now we look at yellow. I'm a big bull on yellow. I like it. I think this company could also earn its way out of problems here. They got a lot of debt. They buy a lot of rigs, a lot of tractors, a lot of trailers, road tractors, not farm tractors. They bought a lot of them, and you can see here at 189 to 190. And if you look at the last 100 trades, you can see the bid and the ask: 189, 190, 1,737 bid, 600 ask. It's fine. They're trading right around 190, 190 and a half, 191. I mean, it looks good for me. I'm up 15 cents, right? I'll take it. SMLP. Let's look at all the real-time trades. There's 2 today. There's a 300 share and 133 shares. No one's really buying SMLP. Then I got some other garbage, which I don't even really follow anymore. I'll turn it off. And then you got my my article there for Medium. That's kind of cool. Did anyone even read it? How do I know? Stats. Do you know I make about 25 cents a month publishing on Medium? That's terrific. Nobody read it. Great. So my these articles are a really hot commodity. I can see that. And again, ATI physical therapy really not moving. Now you can spend the whole day looking to see I'm at 29 and 17. I'm at 97, 26.97 to 28.06. So if I was going to buy it, I would probably put an order in at 27 cents, and I'd probably get some. Maybe not right away. Maybe I have to wait. Maybe I put it at 27.50. Maybe I put it in at 28. Just say, heck with it. I want some shares, right? It's interesting. No one's really stepping up. This thing's not trading at all. So now I'm going to start shutting things down. Because I don't really care. The S&P 500 isn't moving. Really at all. It's very flat. The stocks that I follow, the only one really up is Atlas Lithium, which I want to short. So I would be losing money if I was short it. We'll look at the longs for today. Not doing well, so you wouldn't have done well today. Again, ATI physical therapy is flat as a pancake. There's no momentum here. In fact, it's negative momentum because of where they were. S&P 500 is just garbage. It's down. You can see the market's dropping. Is there any news maybe? Not really any news. This hasn't traded since the 3rd. I guess that's a pretty illiquid security. I just have to wait and wait and wait for it. Yellow isn't really moving. $1.90. I think that's up 2 cents. 3 cents. It's up 3 cents, Jeffrey. All right, not great. Not great. What else we got here? So that's ATI physical therapy. I guess I could open up the same chart for yellow. That way it's easy to find. And you can see here, this is more choppy. But it's got some positive momentum today. Some MACD and some RSI. So yellow's looking pretty good. Maybe between the two of them, I break even today. And that's fine. Let's take a look at the book viewer. ATI physical therapy. Really nothing to report here. There's no action in this book. It is a boring book. Here's my 2 shares. Let's look at yellow. Is there anything going on with yellow? I mean, there's some depth here at $1.86, and there's a $1.94. It looks like it's probably the same trader doing the same thing, bracketing around 8 cents. So they could basically buy it all day long at 186 and sell it all day long at 194. It's good business if you can get it. ATI physical therapy. You know, I told you I was doing the spreadsheet. I've also got open the earnings summary so I can fill in some of those blanks. I've got my 2 runs that I did, and there's lots of information here, but I'm not going to really talk about that today. That's not a today discussion in this video. Anything else? Oh yeah. If anyone has trouble sleeping at night, anybody have trouble like insomnia, you should listen to the Citibank Q1 earnings. The CEO spoke, and I swear the CEO, Jane Fraser, has about the most positive take on a bank stock that I've seen. Then you got Mark Mason, who's the CFO. He's walking through the numbers. I swear, I'm so tired listening to this that even now I'm yawning in the middle of my video. I'm not even sure I like the story, but it's just boring, right? At least when you listen to JP Morgan Chase, there's a little more fire in the belly there, right? You get a sense a little more professional, a little less blowing smoke up your butt. Because honestly, see, JP Morgan Chase, they don't see it. They don't see the run rate continuing. They think they go from 84 billion to 80 billion in earnings. And the medium term, they're going to get down to the 70s. They just don't see it. They see the net charge-off rate at 2.6%, which is higher. They see recession risk. They see all kinds of problems, and they're not afraid to tell you. That's helpful. Wells Fargo, I haven't listened to yet, but I'm pretty sure
file today containing.
We're going to find out that Wells Fargo has their own set of results, their own set of concerns, right? Revenue's up 17%, net interest income's up 45%. Pre-tax profit is up 82%. Wells Fargo looks like a friggin' hero. Provision for credit losses of $1.2 billion. Net loan charge-offs at $604 million. Charge-off rate of 0.26%. I want you to think about that for a minute. 0.26% compared to JP Morgan Chase. They don't have it. They don't have it. Credit costs. They just have it in the billions. I don't know what their net charge-off rate is. Let's do a search. They should have it. Yeah, 2.6%, but that's card. So, okay, maybe Wells is so much better than JP Morgan Chase. It's possible. Wells has got more of that California feel to it. It's a little bit different. All right. Well, thank you for watching. I appreciate it. You see yellow is back to 190. Now, I'm not seeing much action with yellow, so I'm not going to sell it. I'm not going to buy it. I'm just going to wait. ATI physical therapy. You know, I see a little weakness today. I'm just going to wait. I'm going to wait it out. Turn off my screens. Atlas Lithium at $23 a share. I so want to short it, but I'll wait that one out too. U.S. physical therapy down 2.25%. Okay. I guess it's just weakness in the cycle. You see yellow again, 190. It's funny, I spend a lot of my time looking at the same charts over and over again. The same data. I should probably just get back to work. I got a list of things I got to work on with my model. So that would be great. But I look here and I see, you know, the market's really not trading where I'd expect it to be trading. We don't have it. We don't have it. An ATI physical therapy, flat as a pancake. Doesn't even look like it's trading right now. See that? It's just flat. So that's okay. And the stochastics are negative, the momentum's negative in the short term. Let's see, anybody tweeted on it maybe? It's always interesting to know. Dollar sign, ATIP. Not much. Just going to wait it out. Anything on CNN? I guess don't go to the wrong house. I don't know. Mauled Russian units. Russian ground forces in the country are approaching exhaustion. There are few reinforcements available. Ukrainian air defenses are depleted. The United States does not expect the war to end this year. Okay. Russia mobilized. They had 300,000 soldiers. But most of their units are battle combat ineffective. It's crazy. Who knows what's going to happen? I don't know. I wish the war would end. Wish Russia would just go home. But that's not going to happen probably anytime soon. So, all right. We're back to doing something else. I'm probably going to just switch over to my server, do some coding, and wish you guys a good day. Wish you guys success in your trading, or if you're learning. And again, I'm going to summarize the findings just so you understand what we think we see in the market. There's a risk-on run, and that risk-on run has an expected return to $1 put into risky U.S. stock assets, and that return is 10.57%. It consists of a 9% price increase and a 1.57% dividend yield. And that is offset by a risk-free return of 4.9%. Your expected market return to risk is 5.67%, and so you buy 5 stocks. Now today, those 5 stocks are flat to down. Now, if you believe that the stock market's going to go up and you're going to earn 8.57%, which is made up of 7% capital appreciation and 1.57% dividend yield, with the same risk-free rate of return of 4.9, then your expected market return to risk is 3.67%. The model suggests that you buy 85 stocks. And you know what? The market is flat to down. You know, within 7 minutes, I knew the market was going to be risk off. And then we went and we looked at FinViz for a nice, clean visual. And you see the market chopped right around the open, and then it dropped. Not by much. It's down 0.3%, but it chopped, then it dropped. And that's it. There's no news on Twitter. There's no news on CNN. There's no news in the news. It's just not much going on. And that's it. Thanks for watching. Hope you liked it. And if you want to learn more, you know how to reach me. Take care.